Harsha Upadhyay, if a compulsive bull like me starts on a negative vein, it just tells you that how the market have been. They've been full of pain.
I agree, Nikunj. I think until about election results, people were sort of ignoring some of the pain that was there on the fundamental side, and it was primarily driven by higher liquidity that was coming from foreign shows, and also positive sentiments underlying in the market. Once the election results are out, I think the focus has come back to the fundamentals, which not all of them seem to be strong at this point of time, while the global scenario or the global macro seems to be quite benign and supportive to our economy, our corporate profitability. Same cannot be said about the domestic fundamentals. I think we have issues in the NBFC segment, which in a way has also impacted already slowed consumption growth, and we are seeing issues in the economy because of the slowdown in consumption. There is a question mark on the monsoon at this point of time. It's too early to say one way or the other, but again, it's going to be more critical this year as compared to some of the earlier years, given the fact that rural economy is already in some sort of a problem, and what happens if there is a weak monsoon. And also we must remember that financial year 2020 earnings growth is largely dependent on corporate banks, where we believe things are kind of stabilizing, but the consumption slowdown could once again hit earnings growth expectations. So these are the worries that the market has at this point of time.
What is the good news, Harsha? Because if demand slows down, earnings recovery for corporate banks will also get challenged, because corporate banks also get a lot of growth from the retail franchise. I mean, for ICICI Bank and for Axis Bank, I think 55 to 50% approximately, plus minus 5% here is coming from retail growth. And like you said, that the only bright spot in the market is that corporate banks will have a better year. If slowdown is going to be painful and acute, I think that also will take a puncture. I mean, that classic corporate bank coming back will also take a puncture.
At this point of time, we don't believe that that's the case, simply because the NBFCs were accounting for almost 1/4 of the overall credit in the system, and most of them have stayed away or not in a position to really lend more into the economy. So that space is being occupied by some of the stronger private sector banks, where capital is not an issue, because even PSUs cannot really make up for the loss that is happening from the NBFC segment in terms of credit growth. So clearly that incremental growth is going to some of the stronger private sector banks, and we do believe that that story will continue despite some slowdown in the economy this year.
Sure. Harsha, you've touched upon how perhaps the government's policy measures will help to ease liquidity, but how do you really see that happening? Can we, really count on something coming from, whether it's the budget, would you look at more from the monetary front? I mean, what do you feel will really help to kickstart this and allay some of those fears around consumption and slowing growth?
Clearly, we don't really expect something very, very significant in terms of announcements during the budget. I think over the years, it's become more of a statement of accounts rather than a forum where policy initiatives are taken up. Yes, it will be continuation of some of the schemes that the government has already been focusing on. I think we will continue to see that momentum growing even in this year's budget. But what is still a question mark is how much fiscal room the government has to really support the economy at this point of time, because given the slower growth, the tax buoyancy is unlikely to be very, very strong. So to that extent, the room for fiscal initiatives at this point of time are very, very limited. We need to see how that pans out. I think at this point of time, the monetary space is much more than fiscal space, and we have already seen couple of interest rate cuts, and given the fact that inflation is running low and the real interest rates are still very high, there is a possibility that we could see more monetary easing going forward, and hopefully that should bring in some amount of respite. It's not just about lower interest rates. I do agree that it's a question of availability of those low-cost funds for growth. To that extent, I think there is no magic wand. It has to normalize, and then only you would see every participant in the economy getting credit at lower rates.
Harsha, hi, morning. Good to have you on the show. You know, just going through the RBI governor's commentary from last evening, talking about financial stability, and he said it in as many words that they are taking steps to increase the resilience of the banking system, and that they are giving a fresh look at the supervisory framework of NBFCs. Would you say that it's a given that stricter norms for NBFCs and perhaps a proper regulatory framework as well is in the offing, and that is something that the market should definitely like?
Yeah, I think that's definitely on the cards. If you look at the business model of some of the NBFCs, it was prone to risk. For example, they were borrowing in wholesale market, lending in retail market. They were borrowing short and they were lending long. So some of these issues will have repercussions as and when there is a change in the liquidity scenario, or when there is a slowdown in the economy. I think that's what we have seen at this point of time. I'm not saying that all NBFCs are facing issues, but at least the weaker ones will need some kind of a support. I think the policymakers are aware of the situation in the industry, and even if they are not likely to bail out individual companies, they I'm sure are looking at the systemic risk that it will pose to the economy. So to that extent, we can expect greater scrutiny and greater control from the regulators.
Harsha, what will turn the tide? What will scare the bears? Where do you think this market, what could be the next trigger which will either stabilize the market or take the markets higher? Because the concerns what we are indicating, they could be prolonged concerns. NBFC slowdown, trade war concerns, drop in fresh capex. These are concerns which will not get better because of, if in this quarter or next quarter. So what is the good news? When do you think this market will turn? When do you think bulls will come out and come back?
One, obviously, if markets continue to fall, at some point of time the valuations will become a support. They may not be a great support at this point of time, but if markets were to fall from here on, at some level you will see valuations becoming a support. Apart from that, I think in the very short term, all eyes would be on monsoon. If monsoon progresses well, and it gives the hope that the rural economy will come back to health, and that will be something that market would look forward to, because most of the earnings slowdown this year is likely to be from the consumption sector. So if there is any positive sentiment around the consumption, then I think markets will take it very, very positively. We also need to see how inventory correction that's happening in the automobile sector pans out, and if there is a complete cleanup of inventory problem, then I think at least the normalized growth can come back. It may not be as strong as what it had been in the past, but at least it will not give further jitters to the market. I think these are some of the things, other than what the policymakers would do in the short term, that will drive the markets forward.
When you look selectively at quality mid-caps, which are the themes or pockets that you're focusing on? Any indication really of of what perhaps you'd be looking at?
We have been adding some position in the chemical space, which is mostly in the mid and small cap space. I think clearly there is a tailwind because what has happened in the Chinese chemicals industry in terms of environmental standards. A lot of capacities have shut, and there is a likelihood that the global imports would start happening from India, and Indian companies have also increased their capacities over the last couple of years, and that should be a real positive. While most market participants are focusing on this issue, which is definitely a tailwind for the industry, there is also another issue in the chemical space where the global giants have consolidated and they are looking for alternate supplies other than from China, because obviously they want to de-risk their business model. So to that extent, they are looking for other global partners, and India happens to be one, because if you look at the quality or the supply timelines from India, I think they should be able to match what's there in the global scenario. So to that extent, this is a second structural positive that's there for chemicals, and that's where we have increased our exposure in the recent months.
Harsha, great to have you on the show. Thank you so much for taking the time out and chatting with us today.